Hello everyone. Chapter 9 is our discussion for today. We're going to look through some slides, narration for rental activities. So we can't leave entirely behind appreciation that we talked about in Chapter 8 because that's an important part of calculating our expenses for rental activities, as we'll see. So everything we learned there we'll apply going forward. So as we look at this, all right, talking about rental income, we're charging people to use our property. A couple of little principles. Security deposits are technically not taxable if you're going to return to the tenant at the end. Now, the IRS does allow you to count it as income, and then when you return it, count it as an expense. And sometimes that's easier from an accounting standpoint to do it that way than it is to keep track of whether the security deposit is such or first month's rent or whatever. Separate them. Just count the whole thing as income when it comes in, and when you return their security deposit at the end, you count it as an expense. So that's up to you, but typically the security deposit is not taxable. Advance payment of rent, when they pay you last month's rent, first month's, last month's rent, doesn't matter what basis, it's going to be taxable at the time you receive it. So then you get to deduct the expenses against that. Of course, depreciation, like we mentioned from Chapter 8. Typically, you're going to use 27 and a half years. We're talking about residential real estate. However, there's also commercial real estate that could be rented as well, and that would be 39 years. If the furnishings, things inside, if you rent that with them, even appliances and stuff like that, are 5-year property inside the rental. Remember, we talked about this. Section 179 is not allowed, but bonus can be on new and then used after September 27th. Remember that rule changed. Okay, so part property. What if you have a side-by-side duplex, you live in one and rent out the other? It's very common. Basically, you have to allocate the expenses between the personal property and the rental property. So duplex, both the same size, exactly. Total income $15,000. Okay, include the rents, and then we take the utilities, mortgage, real estate, insurance, and depreciation, and take it in half, and that's what we can deduct against our $15,000. Then the other half, only the mortgage, interest, and real estate tax would be deductible on our Schedule A. That's our personal part. That goes on the Schedule A. So now if they're not exactly the same size, you can use square footage to divide the two. If they're close, then you're probably okay with doing 50-50. But the fallback is square footage. The cost of painting is personal expense because it's on our side. What about when you convert it between the two uses? You get rental use as soon as you offer it for rent. That's kind of important because you might sit there vacant for a couple of months. Okay, the part that's for personal is, again, personal expenses, and then the part of the year that for rental is rental. So we have example. We start our expenses on April 1st, and that. So the part of the year from April 1st to the end of the year would be rental. From January, February, March would be personal. All right, so what if we have two homes? We actually, or even our own home, and say we live where the Olympics is, and we decide to rent out our house for a week during the Olympics for some exorbitant amount because that's what people are willing to pay. If it's less than 15 days during the year, doesn't matter what houses or how many houses, if it's less than 15 days, you don't have to report the income. Can't take any expenses either, and all your expenses are just normal, meaning that you get to take the regular expenses on Schedule A. So basically, if it's less than 15 days, you ignore it, okay? So $5,000, 10 days of the year, okay? We're going to less than 15 days, not going to include $5,000. We're going to still deduct the interest and real estate taxes the same way as with others. The insurance, utilities, and depreciation are still non-deductible regardless, just as if it was a personal residence. So, what happens when it gets more than 14 days during the year? Okay, now we have to allocate between rental and personal use, kind of like we did when we owned half and half. Now we're going to do it based on time. All right, so more than 14 days we have to allocate. So our second home for 60 days during the year, expenses related to the home for the year include so forth. Okay? Since it was rented for over 14 days, we have to report the $10,000 in income. We don't get to ignore it. And then we have to allocate the expenses so they can offset the rental income. How do we allocate those expenses? Typically, or the way the IRS says, is we take the days rented at fair value divided by the days of use during the year. Okay? So that days rented at fair rental include days where we receive a fair rental price for the property. Anytime we give someone a break, we give it to them for half price, or because they're a cousin or something, those don't count as rented at fair value. All right? If it's offered for rent but not actually rented, they are not counted. And then the days are used is all of the days we used them, not the ones that are vacant are included in that number. So that would be personal use and rental use. Now, there is an alternative rule the tax court has allowed, and that is that you can allocate only mortgage interest and property taxes, not any of the other expenses. All the other expenses have to be done in the way that it was shown earlier. But mortgage interest and property taxes on a vacation home, personal use over 14 days, a rental use is over 14 days. Instead of a ratio of days rented to days used, you can use the days rented divided by 365, with the idea that mortgage interest and property taxes are on the home whether it's being used or not. So this will result in a lower amount of interest and taxes being allocated to the rental portion and a higher amount being to the Schedule A, which doesn't generally look like a good idea, except that if you know that you're going to have more expenses than income for the house, then it's better to have it allocated to your Schedule A, and you can use it on your itemized deductions. So we'll see, as we see later, this next slide, there's a rule that says you cannot have a loss on a vacation home. If it's considered a residence, that you can only deduct the expenses up to the amount of the income. No loss allowed. And you have to deduct the expenses in this order. Notice appreciation is always last, meaning that that's what's going to be carried over to future years. Okay? So depreciation is always the least favorable expense. So when does it become a residence? Well, if you have a vacation home, you have a second home, and all you do is rent it out, then it's just a rental. Say people rent it for 3 weeks out of the year, and the rest of the time it sits vacant. That is a rental. That is not a residence. But as soon as you start using it for both, meaning you use it for 14 days, greater of 14 days, or 10% of the days the home is used, rental price. So those are your personal use days. So you have to compare how much time it's rented to how much time is personal. If there's no personal use, then obviously this doesn't qualify. And it's just a rental like any other rental, and you can have a loss on a rental to some extent. We'll see later that there's overall restrictions on losses, but it was not subject to this loss rule. So if that's an issue, we need to know whether it's a personal day or not. What constitutes a personal day? So personal use includes when you're used for the purpose other than making repairs or maintaining home. Meaning, if you're there maintaining the home or fixing it up, then it's not personal use. So the key thing is when you're going to go visit your rental home, then you need to do some fix up on it so you can show that it was for you were there for making repairs. Anytime somebody's paying less than fair rental, your brother stays there for half price or much less than normal, that is a personal use. Even if a family member pays full price, if it's not their main home, it's still personal use. And then if you donate it for a charity, say you auction it off at a charity auction, the use of your vacation home, that's personal use. So there's example, personal use is 30 days because 5 of those days he painted the exterior. So out of the 35 days he was there, 5 were for painting, and so only 30 are personal. It's residence because his 30 personal days are more than the greater of 14 days or 4.5 days or 10% of the rental. 175 days, parents use a home for 17. They paid a fair rental price, okay? So it's not their main homes, therefore their 17 days count as personal days, but they also count at the time of day, the number of days rented at a fair rental price, okay? So they go on the top and the bottom, or both sides of the comparison. Does not qualify as a residence because 17 days is not bigger than the greater, notice it's the greater of the two, 14 days or 19.2 days, 10% of the fair rental days. So those 17 days saved us this time because they paid fair rental price, and this is not a residence, and therefore it could have more expenses than income. Now this is all reported on Schedule E. Now I've got another podcast that walks you through the Schedule E, but this is an example of filled in Schedule E real quick. Physical address of the property, all about the types of property that it is, the days are used, personal and rented, just what we just talked about. This is where you report that information. You put all your expenses, your income at the top, expenses down, listed there. You've always got other if you don't find something listed. And then we have to worry about at-risk rules and passive activity rules before we know how much of our loss can actually be deducted. So we may have more expenses than income, but we don't know how much could actually be used of that loss until we use another form. And we'll see that here in just a bit in our second podcast on this topic.